And welcome to another Paper 3 presentation. In the previous video we looked at flows in the form of remittances and illegal flows, focusing on human trafficking, fraudulent goods, fraudulent medicine and fraudulent food. In this video we'll also look at foreign direct investment. Like the last video, we'll be trying to link Paper 3 questions, in this case to global resource consumption and the Human Development Index. These are themes that we've looked at in Papers 1 and Papers 2. All the way through this video, you will see that there's a strong link to SDG 8, decent work and economic growth. But there are other strong links to other sustainable development goals. So let's jump right in. So as we have seen, foreign direct investment is a way of a transnational corporation to invest money in a foreign country. This is an important flow, and along with remittances in the 21st century for many countries, form one of the two most important forms of financial flows. Remember as well, in our increasingly diversified global economy, this flow isn't necessarily just from more economically developed countries to less economically developed countries. In the last few years, there has also been a recent phenomenon of investment flowing from less economically developed countries to more economically developed countries, specifically India and China. So, as with everything, foreign direct investment has pros and cons. As we said before, there's a tight link here between FDI and SDG 8, which is decent work and economic growth. In the lesson, we'll dig down a little deeper into the pros and cons of foreign direct investments. One of the biggest criticisms of foreign direct investment is it's very much based on the trickle-down theory, and we've seen that the trickle-down theory actually doesn't work in practice. Very little of the wealth from the top 1% of the world's population actually trickles down to benefit the poor people below. And this goes really against a lot of the Donald Trump economics that are currently governing many parts of the Western world. The trickle-down theory simply statistically does not work. This has, of course, big implications for the Human Development Index and SDG 8. But also remember, you can look at other SDGs, for example, those that focus on health and those that focus on education. The trickle-down theory simply does not work for the poorest. However, foreign direct investment is a very important financial flow, and we can see at the current way the world is developing, Asia, and particularly South Asia, China and Southeast Asia dominate the world's financial foreign direct investment. Foreign direct investment and trade is really tightly focused to Asia and the Pacific at the moment, but the Chinese One Belt One Road initiative will probably change this economic landscape and mean that foreign direct investment starts to filter into other areas along the One Belt One Road project. Again, emphasising that it's the tight link between decent work and economic growth. Part of the foreign direct investment, and we've already mentioned this, where actually sometimes foreign direct investment does occur in the opposite direction from what we expected. For example, Indian investment in Europe and Chinese investment in Europe. Together, along with the shift towards a foreign direct investment being focused on the Asia-Pacific area, this concept is known as global shift. So the current amount of economic investment in global terms is quite literally shifting away from the more economically developed countries, that of North America, Europe, Australia and New Zealand, and it's shifting towards less economically developed countries, or as we're starting to realise, a better term for these countries would be newly industrialised or emerging countries. As you said before, these countries are focused mainly around the Pacific region, with China being one of the largest, one of the most significant examples. However, we are also starting to see a global shift towards certain economies in South America and South Africa, the Republic of South Africa. One of these largest shifts and most significant, if you're living there, is that of economic investment in Vietnam. Vietnam has one of the fastest growing economies at the moment and is poised to be one of the new Asian tigers. Massive amounts of foreign investment in the form of FDI is coming into Vietnam, and a lot of this development is coming from neighbouring countries. Vietnam is receiving a lot of investment, particularly in its garment industry and assembly industry, from China. Remember, we looked at China, and with its overheating economy, even the wages in China are becoming too expensive. So Chinese companies are actually starting to become more like transnational companies and outsourcing a lot of their labour to countries like Vietnam. Of course, as we've seen, FDI, and in the case of Vietnam, has its advantages and disadvantages. But this movement of FDI does give the opportunity for decent work and economic growth for many citizens of Vietnam. This global shift can also be seen in the urban environment. In countries like Vietnam, cities like Hanoi and Ho Chi Minh are growing very, very fast. In particular, there's the growth of high-rise luxury apartment blocks, but in general, new economic growth in cities. People are quite often surprised to see skylines like this one in countries like Vietnam. It really does not fit in with what we would have expectations of that country would look like. However, as we've seen in China, do bear in mind that we do have economic development tightly focused on one or two urban areas. And when you move out to the rural areas, there's a very, very different situation. So very quickly, countries like Vietnam might be in a situation where average incomes and GDP per head in their primary urban areas are getting very, very close to that of middle-income countries, or even some countries within the European Union. Part of this global shift is also focused around cheap imports and the ability to import and export items very, very cheaply. Quite often there is a fallacy that companies move to less economically developed countries because they have lower levels of environmental regulations. While this is a cost-saving factor, which might be a consideration of the company's balance sheet, in comparison to things like political stability, the availability of a good and affordable labour force, and the ability to tap into global infrastructure networks, all of these factors are far more important, and the savings made by looser or less regulated environmental legislation would be lower down on the company's balance sheet. So part of this global shift is also the growth of global infrastructure. This infrastructure, as we've seen in previous units, is most tightly focused around shipping. There are, of course, advantages and disadvantages. Certainly the political landscape in America has really been rocked at the moment by the growth of Chinese imports and the perception by the United States of America that America is losing its manufacturing jobs to countries like China. And this has caused in part, the growing trade war and disagreement between China and the United States of America. Again, you could turn around this disadvantage to say that it's actually an advantage because it forces political dialogue, agreement and consensus between countries with very, very different political perspectives on the world. Another one of those global shifts is very much seen in the United States of America, in particular the previous manufacturing heartland of America, sometimes referred to as the Rust Belt. As we've seen before, Politically, this is a very, very sensitive issue, and a lot of factories are closing down because they are outsourced, they are moving their operations and manufacturing to Mexico and increasingly to China and the rest of Asia. So this is working in the opposite direction of not having decent work or economic growth for many of the former manufacturing economies in the manufacturing heartlands of countries like the United States of America. Again, looking at another one is another problem could be that as countries move towards manufacturing items, there is a reduction in their food production base. This could seriously compromise the ability of a country to achieve SDG 2, which is zero hunger. The growth of the middle class also means that more and more resources are coming out of agriculture and into manufacturing. You may see this as a good thing, and certainly can be linked to the global trends in consumption. But if you're eroding a country's ability to produce its own food, you're increasingly relying on imports. If a country is only at the early ages of economic development, this could cause quite a lot of problems if there is a global recession, because the country simply might not be able to afford those imports. As we've seen, this one has a lot of SDGs. Certainly we'll be looking in a little bit more detail about the environmental damage and the environmental changes that a shift in both consumption with the emergence of the global middle class, but also a geographical shift of manufacturing towards less economically developed countries. So this, you might want to focus on SDG 12, 13, 14 and 15, because the shift in manufacturing, foreign direct investment and transnational corporations operating in less economically developed countries does have significant pros and cons for environment. Hey guys, as always, I hope you enjoyed this video. If you did enjoy it, please give it a thumbs up and leave a comment below, and consider subscribing to my YouTube channel.